We're here to guide you if that is something you still want to consider. I've seen some clients use this for the purpose of funding a vacation annually, or just knowing exactly what to expect out of this product, and no market surprises that come with it.
Absolutely.
Now with the fixed index annuity, has the value to serve two purposes. One would be for accumulation, one would be for lifetime of income. And since we're focusing in on that lifetime of income, what we're seeing is the key word in a fixed index annuity is flexibility. The flexibility that we have with a fixed index annuity is the big value add that we have in a comparison to the single premium immediate annuity or the deferred income annuity. And with that flexibility comes a lot of features, and that's centered around that deferral period that we have. Also coming with the optionality to take out withdrawals. So it creates some leverage that we've got that other annuity options just don't have.
Yeah, that's really the cool thing about a fixed indexed annuity, is that it's a hybrid of sorts where it incorporates a lot of the good features of the other types of annuities out there and kind of packages them into one product. And again, you're talking about the flexibility of a fixed indexed annuity, and I can't express more how if you're looking for guaranteed income in retirement, there's no more powerful vehicle to leverage than the contract of a fixed indexed annuity with a guaranteed lifetime income rider. Those contracts, those lifetime income rider contracts, are pure gold when it comes to building a retirement plan into the future. So a common way that these are often used is for people that are entering that retirement red zone, when they're approaching that 10-year window of when they expect to retire. And they know that, losing any part of their nest egg at that point could be critical to the overall success of their retirement. It can really tell them if they're going to be able to retire or maybe they're not. And to mitigate that risk, right? To mitigate that risk of potentially losing a significant portion of your nest egg in the event of a market downturn and you're still invested at a high level of risk, you can risk off a portion of your nest egg, put it into a fixed indexed annuity with a guaranteed lifetime income rider, and still build that income benefit over the next 5 or 10 years or however long it is in that 10-year window when you're ready to retire, and leverage the guarantees of those income rider contract rates. And right now, depending on the specific product at the time of this recording, we're seeing income rider rates on that income benefit value anywhere from 7 to 10%, depending on the specific product. And all of that is guaranteed contractually. It's not tied to the markets. Yes, it's an indexed annuity, and it does have some features that can grow the account value in a way that uses the indexes as a driver for that account value growth. But when we're talking about the income benefit value, that is where the contract of the income rider is going to grow that income benefit value at a guaranteed rate anywhere from 7 to 10%. And it's very, very powerful. Oftentimes you can get an upfront bonus on those income benefits. I'm not a big bonus guy. I think a lot of it's marketing fluff. So I want to just go ahead and put that disclaimer out there. But when it comes to looking at income benefit value and growing a pool of money that can then be used for a guaranteed lifetime payment in the future, it's a very powerful tool to help mitigate unfavorable sequence of returns risk over that 10-year window leading up to when you're retiring.
Yeah. And I'll tell you, between you and I think we both see situations with our clients where they may say, Zach, Jeremiah, I plan on retiring in 5 years, but what happens if I retire at year 4 or year 3 or wait till year 6? Well, again, this goes back to working with an expert in the field, because with the tools that we have, we can show you which options are your best solutions within that time frame. And maybe a handful of companies provide the optimal outcome that you're looking for based on that window of 3-year to 6-year retirement period. And we can find the right solution that best fits that need. But, these are the questions that come up in the conversations of, hey, I don't know exactly when I'm going to retire. Well, that's okay. Let's try to game plan so we know what to expect if you do retire earlier than you initially planned.
Yeah, and I think that's important to note, right? Is again, we keep talking about flexibility, and a lot of the people we speak to, like you said, they don't know exactly when they're retiring, but they have a ballpark range. A lot of times they're, you know, doing contracting work or something, and they might be on a contract. They don't know if it's going to be renewed or what have you. But regardless, the flexibility in these income rider contracts is an amazing thing, because let's say we plan to retire in 5 years or 7 years, but something happens and you're forced into retirement earlier than anticipated. Rest assured that even though we did the planning for that 5 or 7 year period, if you need to activate it sooner, you absolutely can, and there's no penalty to do so. A lot of people oftentimes think, well, if I buy this annuity for a 7 years deferral, what happens if I need to activate it in 3 years? You can activate it. Most of these annuities in these income rider contracts, you can activate the income anytime after the first full year of the contract. The only difference is obviously, since you're not growing it anymore and you're activating the income amount's going to be less. So the longer you defer, the more you're securing that guaranteed income rider roll-up rate that's building that income benefit value. And in addition to that, there's still those mortality tables that are playing in. Every year that you advance in age, the payout percentage of that total income benefit value pool is also increasing in most cases. So, but it's all about the flexibility and knowing that, hey, you're buying this income rider, which is a contract. It's a schedule. You're buying a schedule. You're buying a schedule of how much interest that income benefit's going to roll up as each year of deferral. You're buying the schedule of if you activated it at this age or that age into the future, it'll tell you exactly the payout percentage that it'll pay. And it's all contractual. If you meet those schedule parameters, that's the income amount you're going to get. And knowing exactly what amount of income you're going to receive and when is so powerful when it comes to planning for the future.
Yeah, and that goes with joint coverage as well, right? So for the spouse to understand it and to understand that process while we go through it, we love to have the spouse with us so that as we're working through understanding what those goals are initially, okay, let's play out those worst case scenarios. What if it does happen a little bit sooner than we initially planned? Well, now Tim or Joan or Pam or Joe, now they understand what to expect, and they're not caught off guard if life does happen to us and something does change.
Absolutely. Yeah. The joint life aspect is super important to that. And then not to mention, again, we're talking about income riders on these fixed indexed annuities. They're not all created equal. So you definitely want to make sure that you're getting the best one for your particular situation. But the income rider and that, again, that schedule that you're buying and how that income benefit grows and what the payout rate's going to be, it's such an important tool to mitigate one of the most, underspoken risks that we all face in retirement. I keep going back to that 10-year window of time when you're leading up to retirement, and even after you retire, the 10 years that follow. That's called the retirement red zone. And the retirement red zone is all about the way that the markets behave leading up to retirement and shortly after you retire. And if you're invested in the markets and you're counting on that to grow your nest egg, which again is for most people their future income pool, that's what they're saving it for. If you have unfavorable sequence of returns during that retirement red zone, again, being the first 10 years leading up to retirement or the 10 years that follow after you retire, if you have unfavorable sequence of returns during those periods of time, you're going to be really in a tough spot if you have unfavorable market conditions just a few years left before you retire, because that's going to change the amount of money that you can count on to serve as a future income source. So if that happens, you're only left with two options. You're either going to retire with less money, or you have to spend less in retirement. Or I guess there would be a third option, and that's to continue working longer than you expected so that you can recover from the losses. But if you, again, risk off enough of your assets, put it into a fixed indexed annuity with a guaranteed lifetime income rider, you can rest assured that regardless of what happens in the markets, and if the markets perform poorly, that guarantee in that income rider contract was growing that income benefit pool at a very competitive rate, so that you can have an amount of money that you can count on. And that's something that I don't think people really understand enough, is that sequence of returns risk.